All right, let's jump right into this. Welcome to this explainer, where today we're going to evaluate a really fascinating situation unfolding in the market using what I like to call the ultimate investor's gauntlet. We're taking the global commerce giant eBay, ticker symbol EBY, and we're running its newly released Q1 2026 data through the unforgiving, battle-tested frameworks of some legendary investors. We're going to channel Warren Buffett, Peter Lynch, and Benjamin Graham, and then pair all of that with modern discounted cash flow models to figure out what this company is truly worth.
So let's set the stakes here. Why are we looking at eBay today? Well, because this mature tech heavyweight is heavily in play right now. GameStop just launched a seriously audacious, unsolicited takeover bid for eBay. They're offering $125 a share, which is a massive 46% premium over eBay's unaffected closing price back on February 4th, 2026. Naturally, eBay's board outright rejected it, saying it undervalues their standalone prospects. But you have to wonder, is the board right, or are they leaving a ton of money on the table?
To figure out if eBay is actually worth that massive premium, we've got a strict Bain plan. First, we'll look at the eBay snapshot, then apply the Buffett lens, move on to the Lynch lens, hit the Graham lens, crunch the numbers with DCF and dividend models, and finally, wrap it all up with our synthesis and final verdict.
Step 1. The eBay snapshot, a business at a crossroads.
Okay, let's lay out the base stats. Based on that 46% takeover premium, eBay's unaffected share price was sitting right around $85.61. Now, what's genuinely wild about their Q1 data is the massive contrast in their growth metrics. If you look at active buyers, they're practically flat, just inching up 1% year over year to $136 million. If you stopped right there, you'd probably think, wow, eBay is totally stagnating. But then, look at the actual financials. Gross merchandise volume, or GMV, surged 18% to $22.2 billion, and revenue jumped 19% to $3.1 billion. On top of that, they returned a staggering $639 million to shareholders in just a single quarter. Basically, eBay is squeezing a lot more value out of its existing user base.
Let's move to step 2, the Buffett lens, quality and the economic moat.
Channeling the Oracle of Omaha means we're hunting for a few very specific things, and an economic moat is absolutely non-negotiable. It's the castle wall, right? We need to know if eBay has a durable advantage, or if they're just a generic marketplace waiting to get steamrolled by Amazon. To answer that, we really need to look at eBay's recent strategic pivot to what they call focus categories. And this is exactly where we see that moat being dug in real time. Instead of trying to sell everything to everyone, eBay is building a deep trench around enthusiast buyers. We're talking about authenticated luxury fashion, refurbished goods, and high-end collectibles. Get this. Golden, which is an eBay company, just had a record-breaking quarter driven by a single $16.5 million sale of a PSA 10 Pikachu Illustrator card. That is insane. By dominating these high-trust, high-margin niches, eBay has actually created a really distinct competitive advantage to protect its profitability. For Buffett, that moat is looking highly intact.
But as we know, Buffett also demands total financial fortitude. He cares deeply about owner earnings, basically the cash a business generates that can actually go to the owners without starving the company's operations. In Q1 alone, eBay generated $898 million in free cash flow. If we annualize that, we are looking at roughly $3.6 billion in owner earnings. Now, what about the debt? They do have about $5.99 billion in long-term debt, but they're sitting on a stockpile of $3.86 billion in cash and short-term investments. That means their debt is highly manageable against that massive cash flow. With the exceptional return on equity implied here, eBay easily clears Buffett's qualitative safety checks. Assuming a reasonable margin of safety, Buffett would likely view this cash-printing machine as a really solid buy.
On to step 3, the Lynch lens, growth at a reasonable price.
Peter Lynch's framework is a bit different. He requires us to first categorize the company's growth story and then judge the price relative to that specific type of growth. So what bucket does eBay fall into? On one hand, you could easily call it a slow grower, since they only added 1% to their active buyer base. But Lynch would probably look a bit deeper and label eBay as a highly profitable stalwart. Why? Because of management's sheer financial engineering. While explicit insider ownership numbers aren't listed here, their massive buyback program acts as a huge proxy for management conviction. They have literally cannibalized their own share count, shrinking the diluted share base by an unbelievable 35.9% over the last 5 years. They're artificially engineering some serious per-share growth.
And the math totally backs us up. Lynch loved the PEG ratio, which is the price-to-earnings ratio divided by the earnings growth rate. Let's run it.
Taking eBay's non-GAAP Q1 EPS of $1.66 and annualizing it gives us $6.64. At that unaffected price of $85.61, we get a P ratio of about 12.8. Now remember, their non-GAAP EPS just grew by a blistering 21% year over year. If you divide that 12.8 PE by the 21% growth, you get a PEG ratio of just 0.61. In Lynch's world, anything under 1.0 is undervalued. So a PEG of 0.61, that makes eBay an absolute screaming buy through the Lynch lens.
Step 4. The Graham Lens. Hardcore balance sheet value.
All right, time to strip away the growth narratives, ignore the buyback magic, and forget the enthusiast moats for a second. We are going to face Benjamin Graham's unforgiving, hardcore balance sheet conservatism. We start with his defensive investor checklist. Adequate size? Yes, passing with flying colors at $22.2 billion in quarterly GMV. Strong financial condition? Pass again. $3.86 billion in liquidity easily covers their short-term obligations. Earning stability? Absolutely. They just posted $512 million in GAAP net income this quarter alone. And a dividend record? Yep, they declared a 31-cent dividend and paid out $139 million. So, eBay cleanly passes all 4 steps. It's a fundamentally stable enterprise.
But stability isn't enough for Graham. He demands a strict entry price based on his famous intrinsic value formula, the square root of 22.5 times earnings per share times book value per share. Let's do the math here. We have our annualized EPS of $6.64. For book value, we take their total equity of roughly $4.41 billion and divide it by an estimated 444 million outstanding shares. That gives us a book value per share of $9.93. Now, multiply 22.5 by 6.64 by 9.93 and take the square root. The strict Graham intrinsic value comes out to only $38.51 per share. At an unaffected price of over $85, there is literally zero margin of safety. Graham would rate this a hard sell and wouldn't even think about touching it at current market prices. It's just way too expensive relative to its physical book value.
Moving on to Step 5, DCF and dividend models. Stepping away from the historical gurus for a moment, let's look at modern quantitative analysis. We need to project the future using forward-looking discounted cash flow and dividend models. Now, because a specific cost of capital isn't provided in our source data, we have to make some standard assumptions to run the model. We'll use our $3.6 billion annualized free cash flow as the starting base. We're going to assume a fairly conservative 5% cash flow growth rate over the next 5 years, which feels right for a tech stalwart. For the terminal growth rate, we'll slot in 2% to mirror mature economy inflation. And for our discount rate, or WACC, we'll use a standard 9% market risk premium. Let's run all those numbers through a sensitivity table, tweaking our discount and terminal rates. If you look right at the center of the matrix, our base assumptions give us a fair intrinsic value of around $101 per share. This is a really fascinating insight. It tells us that the unaffected $85 price was definitely undervalued, but it also heavily implies that GameStop's $125 offer is leaning on some extremely aggressive synergy expectations. Likely those $2 billion in cost reductions they were bragging about, because $125 is sitting at the absolute top end of our most aggressive DCF scenarios.
And we absolutely can't ignore the other huge quantitative factor here, shareholder yield. When you step beyond just standard dividend discount models, you have to factor in eBay's massive 5.84% buyback yield right alongside their 1.06% dividend yield. Combine those, and you get a total shareholder yield of 7.15% over the trailing 12 months. That is huge. The sheer volume of cash being continuously returned to investors acts as an incredible floor for the stock price. I mean, it's really hard for a stock to completely tank when the company is buying up nearly 6% of itself every single year.
Finally, Step 6, synthesis and final verdict. Well, we've officially run the gauntlet. We've scrutinized the moats, the growth rates, the hard book value, and the projected future cash. Now let's pull all these threads together. Synthesizing the data, eBay gives us a slightly fractured but deeply compelling picture. It is a definite buy for Buffett-style investors who want strong cash flow and a durable enthusiast moat. It's also a clear buy for Lynch followers since that 0.61 PEG ratio offers growth at a wildly reasonable price. However, it's a strict sell for Benjamin Graham purists who absolutely refuse to pay a premium over physical book value. And finally, based purely on our base discounted cash flow models, it sits at a solid hold, right around $101 a share. So, what is the grand takeaway here? The board flat-out rejected GameStop's $125 a share offer because eBay really is a highly profitable stalwart. They are aggressively shrinking their own share count while totally dominating high-margin niches. The fundamental strengths are absolutely there. The real question isn't whether eBay makes money, it literally prints it. The question you have to ask yourself is, based on these master frameworks, at what exact price does this cash-generating stalwart actually enter your portfolio? Think about which framework best aligns with your own strategy. Thanks so much for joining me on this explainer, and keep running those numbers.